What do you think happens when two billionaire titans get into a fight? One bets $1 billion that a company is a complete fraud and that their stock is going to tank, and the other buys as much stock as he can to force the price even higher. Not necessarily because he believes in the stock, but mainly because he just wants to stick it to the other guy.
I really sort of had it with this guy, Ackman. He's like the crybaby in the schoolyard.
Roadkill on the hedge fund highway takes advantage of little people.
Can't hear what you said, Bill. I'm sorry, I can't hear you.
5 years later, Bill Ackman lost over $500 million on his short position, while Carl Icahn walked away with over $1 billion in profit and a 26% stake in Herbalife. This battle went down as one of the most high-profile and brutal short-selling battles in recent history. But how does something like this even happen? Why would an investor directly bet on the failure of a company and then spend $50 million of his own money to convince everybody else of his opinion? What do investors like this even stand to gain? And how the heck does the whole plan fall apart when one billionaire decides to fight back? Welcome to the high-risk world of short selling, where you can bet big money on the failure of a business, and if you're right, you can walk away with a massive profit. But if you're wrong, you could lose an absolutely unlimited amount of money. It's 1602, and the Dutch Republic has just authorized the creation of the VOC, or what you might know now as the Dutch East India Company, the first truly global corporation and the first company to finance its ventures by selling shares of stock directly to the public. And the VOC had one goal: dominate the spice trade. And the public was able to get in on the action too. With VOC shares available to the public, individuals were allowed to buy and sell stocks among themselves for the first time, effectively creating the first modern stock exchange. And like any stock market, there will always be winners and there will always be losers. Around 1605, Isaac Lemaire, who was a co-founder and initial investor in VOC, got into a disagreement with the VOC founders and was removed as a director, which led to history's first ever short sell. Basically, Lemaire wanted revenge, and he wanted to make some money in the process. So he and a few of his trader buddies got together to actively drive the price of VOC shares into the ground. Lemaire and his buddies basically got together and placed bets on the stock price going down and then proceeded to force it down by telling people that ships were sinking, cargo was being lost, and that the company was falling apart. Although Lemaire's plans eventually failed, this process would go on to be the genesis of what we now call activist short selling. Now, in today's world, there are regulations on what you can say and do to drive a stock price down, but traders still use some of these same tactics today, which is why short selling is one of the most controversial and high-risk ways to make money on Wall Street. But to better understand short selling, we should break down what a short position actually is. At its core, if you are shorting a stock, you are betting that the price is going to go down. To place that bet, an investor will borrow shares of a stock they believe is overvalued and then immediately sell them at the current market price, all with the simple goal of buying those same shares back later at a lower price than they originally sold them for. When the price drops, they repurchase those shares at the new lower price, return the shares to the broker that they borrowed them from, and then pocket the difference between the selling price and the buying price. For example, if an investor borrowed and sold shares at $100 each, then 1 year later bought them back at $70, they'd make a $30 profit per share after returning the borrowed shares to the broker. Simple if it works, but if the price doesn't go down, things can get very scary very fast. When you normally buy a stock with the hopes that the price will go up, you can't lose more than you spent on the stock because the lowest a stock can fall is $0. If you bought $10,000 in Apple stock and it crashed to zero, you'd simply lose $10,000. But if you short a stock and the price goes up, you could be on a ride for seemingly unlimited losses, which is where this gets so risky. Since you borrowed those stocks and sold them, you are absolutely 100% required to buy those shares back at a later date, whether or not the stock price goes up or down. There's no way out other than repurchasing those shares. And since short sellers are required to trade on margin, which is another tool that allows you to trade more money than you actually have, the brokers providing that margin or the extra money can trigger a margin call, demanding all of their funds back, and if you can't pay them back, you are forced to liquidate your entire position. So even if you think you have the guts to ride out the pain in hopes that the price will eventually go down, sometimes you don't even get the chance. As you can see, short selling is one of the most complex ways to trade the market. So why would investors even bother with it? Well, there's three main reasons investors will short stocks. Number one, they believe the stock is overvalued, meaning it's trading at a price higher than the investor believes it's worth, and they think it will eventually come back down. Number two, they're hedging existing positions. This is a common practice to prevent any big losses while trading. Say, for example, you own 100 shares of Apple, and you believe that Apple stock is going to go up over the long term. But you also think that tech stocks overall might dip in the near term due to interest rates and slow sales. To hedge your Apple bet, you could short the NASDAQ, basically betting that the tech sector as a whole will fall, but Apple itself will continue to rise, allowing you to make money if Apple wins. And if Apple loses, your short on the NASDAQ will help offset some of the losses. And the third reason investors short stocks is to protect their portfolio during market downturns. There will always be pullbacks and bearish cycles in the market, and investors do everything they can to avoid losing money, even if that means going against their typical thesis of growth and instead betting on the prices falling. Theoretically, any investor could take part in short selling because of those three reasons, but the ones that typically do are much more of a contrarian thinker and like to go against the grain. They typically have very high risk tolerances, and they're willing to put their money where their mouth is. But as history has shown, that doesn't always work out the way they want it to. Let me introduce you to the short squeeze, a short seller's worst nightmare. It's January of 2021, and a few retail investors on Reddit figured out that multiple hedge funds had placed massive shorts on GameStop, expecting it to basically go bankrupt. So massive, in fact, that they borrowed over 100% of the available shares in the company to repurchase later at the almost $0 expected price. Over the next 3 weeks, one of the most memorable and exciting times in the stock market took place. Now, during this time, I was in grad school studying for the CPA exam, and when I tell you this is all anyone could talk about, I mean it. Everyone was investing in GameStop and other highly shorted stocks. It didn't matter if you had ever bought a stock before or you were a seasoned veteran, everyone was talking about this and wanting to get in on the action. And this all created one of the largest short squeezes of all time. Melvin Capital and other hedge funds had borrowed shares and sold them, all with the requirement to buy them back at a later date, just like we talked about. But when everyone started buying in to stick it to the man, the stock price absolutely exploded, going from $17 to $483 a share in less than 3 weeks. Now, remember when I said that when you short a stock, you can lose an unlimited amount of money? Yeah, that's pretty much exactly what happened. These short sellers were watching the stock climb higher and higher, and they tried to hold out as long as they could, but you can only take so much pain before the entire house of cards starts to fall. With each tick higher, the short sellers started to bail out of their positions, buying up stock to get out of their short position while ironically driving the stock even higher. All of this led to catastrophic losses for some hedge funds. The most notable being Melvin Capital, who lost $6.8 billion in just January of 2021, and later having to shut down the entire firm in 2022. All while some retail investors rode the wave to the top and cashed out for millions in profit. But that's a story for another day. The squeeze is a short seller's worst nightmare, and most prefer to hide in the shadows to avoid a GameStop situation. Because short selling can become personal very quickly, like Bill Ackman learned in 2012. Because the markets are speculative, it doesn't matter if you are right or wrong. You could have the best research and the most conviction that a stock price is going to go down, but if the market decides otherwise, or a billionaire decides to go toe-to-toe with you, there's really nothing you can do about it. Bill Ackman and Icahn's fight lasted 5 years, and no matter how hard Ackman tried, he could not get the price to go down the way his research expected. Which is exactly why shorting a stock is not for the faint of heart. You have to be ready to fight, and you have to be ready to abandon ship if the tides start turning on you. So what does this all mean for retail investors like us? Well, as with anything in the stock market, this all comes down to your risk tolerance and your investment bias. If you see yourself as a contrarian thinker and are more biased towards the downside, there's nothing wrong with short selling. But if your mind thinks more in terms of long-term growth and upward trajectories, you might want to steer clear of short positions. At the end of the day, the most important thing to remember is that with a short position, you are risking an unlimited loss for a limited and capped win, unlike your typical long position where you are risking a limited loss for an unlimited growth potential. If you prefer the downside, look into put options. These allow you to bet on the downward trajectory of a stock without risking the unlimited losses like a short position. And if you want to learn more about put options, leave a comment down below and I'll make a video about it. If you like this, you might also like this video about venture capital investors and how they create trillion-dollar industries off of high risk, high reward bets.